Hello, chart watchers, and welcome to this Wednesday, June 19th, 2019 Market Watchers live show with your host, Tom Bowley and Erin Swinland. For those of you joining us for the first time today, welcome to the show. And for our regulars, welcome back. Well, after a big day yesterday, you can see the Dow Jones Industrial Average trying to tack on a little bit more, up 46 points. The S&P 500 up 1. The NASDAQ moving back into positive territory. It was down slightly earlier. It is up about 4 points right now. The Russell 2000 up 1.5 points. 10-year Treasury yield moving a bit higher as we see some Treasury traders moving out of that area ahead of the FOMC announcement this afternoon. Volatility index continues to drift lower. It is up a little bit today, but you can see that steady move down in June as the equity markets have been moving higher. Financials leading to the upside today. Healthcare also having a strong day, and in particular, nice breakout yesterday on the XLV out of this flag formation. Nice flagpole, sideways action in the flag, and now making that breakout yesterday. So XLV looking pretty strong here. Materials not doing so well today, but this has been a group that has done extremely well so far in June. A little bit of profit taking. We'll see whether or not those moving averages hold on a pullback, but currently looking much better than it's looked in quite some time. The healthcare providers helping to lead the healthcare group to the upside. You can see very strong action here, moving to multi-month highs. The steel group, this is a little bit of a surprise. The group is up about 2% today, a little over 2%, but this comes on the heel of U.S. Steel, indicating that they are lowering their forecast. They actually provided reduced guidance going forward. That could be a sign that maybe the worst is behind the group. Home construction taking a big hit, but the 10-year Treasury yield is up ahead of the FOMC meeting this afternoon, the announcement, and I think probably what we're seeing here is just some traders locking in some profits ahead of that. United Health, that's the reason that we're seeing the healthcare providers performing so well. This is the top performing stock in the Dow so far today. Goldman Sachs right behind, but you can see Goldman Sachs has some overhead resistance back from the middle part of May and also recently, earlier in June, in this 198, 199 area. Notice the 50-day moving average coming in at that area as well. And then finally, Adobe Systems, another software stock coming out with great numbers after the bell yesterday. They reduced their guidance going forward, but the market, I think, looking at Adobe as one of the leaders. I think the fact that this stock had underperformed the software group for the past year, I think some negativity was built in. And I just simply think that the report that came out yesterday was better than a lot of traders were expecting. You can see now we are challenging a key overhead resistance level from early May, just above that 290 level. We'll see if we can get that breakout. All right, Erin, it is another trading day, middle of the week, Fed day. How are you doing today?
I'm doing great. I guess I'm feeling the same way as everybody in the market, a little bit tentative right now as we prepare for that announcement.
Yeah, and if there's been one disappointment in the market maybe over the past 6 months, it's probably been the Fed. I think a lot of traders would say that the Fed's been a little slow to act. And I know we got a special guest on here today, Greg Harmon. I know he's going to be talking a little bit about the market heading into this Fed meeting. But how are you doing, Greg?
I'm doing great, guys.
All right. Welcome to Market Watchers Live. We have never had you on the show, but so this is going to be a pleasure not only for us, but for all of our viewers out there. You want to give us maybe a 15-second sneak preview into your talk at 12:20?
Yeah, sure. As you all just saw, Tom went through and gave a kind of a rundown as to what's happening in the markets. I'm going to take a step back from that and look at things from a much longer-term perspective to see how they fit in with what the prevailing view is as to what the Fed should be doing.
All right. Well, that is awesome because I know I'm guilty of this. I tend to focus on the short term. I still have a big picture outlook, but when you do the show every day, we do tend to focus a lot on what's happening today. So I think that'll be great to be able to step back and take a look at the bigger picture. So if you can stick around with us for about 15 minutes, Greg, love to hear that presentation.
I'm here.
All right. Erin, let's go ahead and get this party started.
Indeed. All right, upcoming schedule. We have tomorrow, Mr. Julius de Kempener. We're going to be doing a live roundtable. So if you want to take a peek at what we look like again, there you go. Mary Ellen will be in to do pop culture stocks roundtable. Brian Shannon will also be in. He's going to come in June 26th. Wednesday. And then June 27th of next week, Dan Russo will be here. And of course, we're getting ready already to start thinking about the 4th of July. So there will be no Market Watchers that day. All right, for today, though, we have that wonderful presentation ahead of us by Greg Harmon. First symbol will be KKR for the 10 and 10, crossing lines, and the scooter report will finish off the show. But let's go ahead and get started with technical news and headlines.
All right. Well, first, there really isn't a whole lot going on today except the FOMC policy statement and their decision. Their announcement will be out at 2 p.m. Of course, everyone's kind of sitting on pins and needles. The market is expecting, not necessarily expecting the Fed to lower rates, but I think the market is expecting the Fed to perhaps change their language, be a little bit more dovish, talking about maybe a possible rate cut down the road. I think that's what the market's going to be looking for. Anything short of that could put an end to the short-term rally in equities. We'll have to see. And also, I think what we're going to want to take a look at is that 10-year Treasury yield, because we are sitting on a very important support line. And I see this so many times when the market, we're getting ready to have a big earnings report or we're getting a big economic report. The market tends to get to a key support or resistance level. And I think in this case, you can see the 10-year Treasury yield coming down to a multi-year support level down at 204. We are up today about 3 basis points back to 2.09%. I'm not at all surprised that the yield's rising. There's been a lot of money that has been rotating into treasuries, and I think there's simply some profit taking here going, taking place ahead of the Fed announcement at 2 o'clock. Makes sense to me. The question is whether or not this support level is going to hold, further out. And if it doesn't, then it could make big changes in terms of how money rotates in equity. So you want to be watching this. If rates do bounce, and I was talking about this earlier, home construction having a bad day today, partly because there have been some pretty nice gains in home construction because of the lower rates. So depending on what the Fed does there, that's certainly going to be one area of the market we're going to want to keep an eye on. As far as earnings reports, I know it's June. We think of earnings season starting in a month, but there are still companies that do report during odd periods of the quarter. One of those is Adobe Systems, a very large software company. They did come out. They beat their top line. They beat their bottom line estimates, but they reduced guidance. The stock, however, really having a strong session, and we'll take a look at that in just a minute. Jabil beat. Lazy Boy came up a little short. Winnebago this morning beat. After the bell tonight, another big software name, Oracle. And this one I don't feel nearly as bullish about going into their earnings. This is a company that has been underperforming its peer group for more than 5 years, and I'm just not expecting a whole lot out of it. I think the group could get a boost if Oracle were to surprise to the upside. As far as the charts go, pulling up the Adobe chart, this is why I think it's so big. I think off of this uptrend, I think we've got a really nice inverse head and shoulder pattern that broke out today with this earnings. I think this is the catalyst to begin a much bigger move to the upside in Adobe. Here's your uptrend. Here's the left shoulder, the left side of the neckline, the head, the right side of the neckline, and then the right shoulder. The reason that this pattern is so important is that when you get into a stock that's downtrending, what you normally see is a lower low, lower high, lower low, lower high, and then lower low. When you get back up to that prior high, that intermediate high, I think that's just telling you that there's a little bit more strength than what you normally would see in a stock that's downtrending. So when you pull back, you hold the prior low, and then you break back out again. I think that is a very, very strong continuation type signal. I think Adobe looks really good. And while you see the Adobe relative strength here versus software, and we talked about this, I know when we had John Hopkins on from Earnings Beats back on Monday, we talked specifically about Adobe and Oracle coming up this week. I felt better about Adobe than I did Oracle, and the reason being, I'm going to stretch this chart out, and let's take a look at those last 5 years. On this chart, I want you to look at the relative strength of Adobe prior to this last year. Adobe has been a major leader throughout most of the run in software. I think this sideways consolidation that's been going on for a year, maybe even a little bit of underperformance. Note that Adobe is actually broken out to new highs. So on an absolute basis, it continues to perform very well. On a relative basis, that's where it hasn't put in that new high. But with the earnings coming in today and the big pop that we're seeing, look to see if we get this breakout on Adobe and whether this relative strength continues to break this relative downtrend line. If that happens, I think Adobe looks much better. Now, let's move on to Oracle because they report after the bell, and this is what I was referring to here. You look at this chart and you say, well, Oracle has broken out to a new high in 2019. What's the matter with it? Well, look at the relative strength over the last 5 years. Oracle continues to underperform the group. So part of the reason why the stock's been doing so well is it's in a group where money has been rotating in on a consistent basis for many years. So yes, Oracle, if you're just looking at your account and you own Oracle, you're making money. The bad news is if you were in just about any other software stock, you'd be making more money. So everything you really need to be looking at on a more of a relative basis. All right, let's take a look at Lazy Boy. Lazy Boy came out with earnings, and I don't need the 5-year chart. Let's go back to a 1-year chart. But Lazy Boy came out with its earnings. They did report numbers that were better than expected on the top line, or excuse me, they actually came in a little light on both the top and bottom line. They did gap down at the open, you can see, and on very heavy volume, we're getting a big reversal. Now, the furnishings area of the market is threatening about a 7 to 8 month relative or absolute breakout. But when you go down to the chart at the bottom here, you can see furnishings relative to the S&P 500. Although maybe they've improved slightly the last 6 weeks or so, you can see this has not been one of the favored areas of the market over the past year. So I think that the stock still has a little bit of an uphill battle. It's not only got to negotiate some key overhead resistance on its absolute chart, but it really is going to need some help from its group. And so for that reason, I would probably stay away from this one for now. And then I wanted to show you Jabil because this was a really nice looking chart. They beat on the top line, beat on the bottom line. They guided in line, but this is a really nice move up. I'm going to be watching to see eventually if we can get back up above that $31 level. Until then, I don't know. I'd say that we probably have a little bit of overhead resistance. Note, however, with this earnings report that it is breaking out to a 52-week high relative to its peer group, and the volume is confirming this move to the upside. So the only thing left is to clear that 31 area on its chart. I'd like to see some volume coming in with that. Okay, next up, I'm going to move into our scooter mover of the day. And our scooter mover of the day, if you go into the dashboard, it was toward the bottom. I'm going to see if it's still here. Actually, it is fallen off the top, but it was still a pretty strong mover. I'm going to bring it up because I like the chart. You can see the move up to $4.76, taking out these prior highs. If we pull up a relative chart, you'll see it's in the pharma group. So pharma's starting to strengthen here in June. We're at about a 2-month high. And then on a relative basis, AKRX was a really bad performer relative to the group, but look at it starting to move back to the upside. So the way I look at a stock like this is if it's beginning to show characteristics of a change in its character on the chart. I think that's what happened back in early May. I think it's pretty big to get this move up, consolidate, and make another breakout to the upside. So this is a smaller company, carries a lot of risk with it, but I did want to mention it because not only is it making a little bit of a move on the scooter, but technically on the chart, I think this is one that we want to keep an eye on. So that is your scooter mover of the day.
All right, let's get started on some upgrades and downgrades. All right, here we go. Let's go ahead, and we've talked about Adobe, so I won't spend too much time, but on that excellent report, we did see Stevens upgraded from equal weight to overweight, and they have moved their target. I'm going to move this way down. They had it at 288, and now they're going to put it up here. Wow, it's go all the way up here to 327. And that's where you would look for where they think the target will be next. Currently, overhead resistance lies right here at about 292. And we haven't quite broken out above that, but look at that beautiful PMO buy signal that's right now intact. And if I get that, OBV going in exactly the direction you want to see it go in. There we go. Right up there. So you want to see that as a confirmation of what's going on as far as the price chart goes right here. And that's what we're seeing. So I would look for that breakout. The PMO is just now turning up and giving us that signal right at the zero line. So that tells you there's lots of strength with that move. Next one up is Carbonite. And Carbonite was upgraded today by Northland Capital from a market perform to an outperform. You know, it hasn't been performing too well, I have to say, look at this. Let's take this across. I mean, we've been looking at from that December low. Most of our stocks that we look at have been going pretty much to the upside, and we've had really some consolidation only going on right now, really in this zone. We had a pop right there, but right here is your trading zone, and we are at the top of it right now. So we did get the upgrade, but I'd be a little bit careful here at that overhead resistance. Notice it also lines up with that gap back here. All right, next one up is going to be LW, which is Weston, and it was upgraded by Goldman today from a neutral to a buy, and they have moved their target up here to $76, right around there. And right now, of course, if I look at that support, we touched down below that yesterday, and now we're starting to make that move back up to the upside. Short-term overhead resistance, of course, right around here at $63. Could be forming what looks like, and let's take a little trend line here, or actually we'll take a little ellipse. What we could be looking at right here is a double bottom. Let's make that bigger. And a double bottom, that would be your confirmation line. We'd look for that breakout to the upside and then a move the size of the pattern. So that would put us right about up here at 66, which does match up with that, area of resistance at the low back here in January. Next one is going to be TripAdvisor. SunTrust is upgraded it from a hold to a buy. They did not give me a target, so we won't look at that, but let's go ahead and look at where our support and resistance lie. So here is I would say the next area of overhead resistance would be right here at that low back from March. I'd be looking for the move to the upside. Here, of course, is the low. We ended up coming in below the previous low right there, but we did get that nice bounce. I think you could even make a case for a reverse head and shoulders pattern forming here. I would look for the breakout above that overhead resistance. PMO is on a buy signal. All right, let's move to a couple of downgrades right now. Honda Motor Company was downgraded today by UBS from a buy to a neutral. Now, this chart looks very familiar, actually. Here we go. There's our support level. Here is the overhead resistance. I would mark that in the short term right about $26. You can see that was the previous gap. It hasn't quite closed it. It looks like it may have closed it earlier. Let's see, on June 11th, but we didn't get that breakout. I would still look for the breakout at this point. That's a really nice PMO buy signal. And notice that the OBV is rising the way you want to see it, as far as the lows on price versus the lows on the OBV. Next area of overhead resistance, I would say look for the gap between here and here, that gap to be filled. So I would look for a move up to about $27. And, you know, it was downgraded, but it's gone from a buy to a neutral. So I think looking at upside potential is still there. All right, this one, Sunpower, was actually upgraded yesterday, but was downgraded today. So Raymond James downgraded it from an outperform to a market perform. And I suspect it's coming off of this, of course, the big move to the upside that we saw. And now we're starting to see that pullback. I'm guessing that they're going neutral. Let's go ahead and bring this chart out just a little bit more. There we go. Oops. Forgive me there. All right, so I'm going to get my horizontal line. So here's the top that we saw back here in July of 2017. That's where I would start to look for that test of overhead resistance that actually lines up fairly well with the gap back here that we haven't seen covered yet. That would tell us to look for a move up to that 1425 area. All right, and that does it for the upgrades and downgrades. Here is the list that we had. I didn't have that many extra upgrades, but there you go. Six Flags was also upgraded today. All right, we'll be right back with Greg Harmon when we come back to our program after this.
The point of on trend is to keep you on the right side of the trend. Mostly dealing with stocks and ETFs, I'm going to point out bullish setups on stocks and ETFs that are in uptrends. I'm also going to look at some downtrends, but those are designed also to tell you which stocks and ETFs to stay away from. The main point is to stay on the right side of the trend, the uptrend.
Welcome back, everybody. It is my pleasure now to introduce our guest for today, Greg Harmon of Dragonfly Capital. Greg, before you get started, I do have one question for you because it is Fed Day, and I know you're going to talk a little bit about that. But, you know, I've made the observation over the past 6 months or so that it seems to me that the Fed Chairman Powell has been a little slower to react to some of the financial markets than his predecessors. Just wondering if you had any comment. You know, he seemed to be slow to get rid of the rate increases back in December of last year, waited until after the market took a pretty big dive. And he's been pretty slow to come around to lower rates. Do you have any opinion there?
Well, I think that that's a good overriding statement and question to get this whole thing kicked off here. From the market's perspective, yes, he has been slow. Is that appropriate, though, is really the question. Mm-hmm. And if I can just jump right in then, I think that there's been a real short-termism that's been going on in the market. You talked earlier about changing character in a couple of stocks and a couple of sectors. And if we look back at from a longer perspective at how the markets have traded, how rates have been moving, we had the first change of character in the markets in December 2015 when the Fed first raised interest rates. And we started moving up from zero. And that continued until December last year. Now, December last year, what did we have? We have what many in the market thought was an inappropriate rate hike. But if you look at some of the evidence, you could certainly make a case that it was appropriate as well. We've got raging employment markets. We've got no inflation. But we had some spikes a little bit towards the end of last year. So is there a transition going on now from that rising rate environment to a falling rate environment? Well, just like some of my friends like to say, markets and stocks don't move up or down. They can move up and down, but they can also move sideways. And that's really what we've been in now. So the market is certainly telling us that it wants to move rates lower. And we're seeing that the Fed, from that perspective, is slower than what the market is looking at. When I was doing some research this morning, I saw that we had about 80% chance of a cut in Fed funds rate by the July meeting, priced into the Fed funds futures market. That's a pretty solid estimate, a pretty solid view that the Fed is going to cut rates from just a few months ago, where in January, where we had Chairman Powell tell us that it was time to pause and to be patient. So can the Fed move that fast? Second question then is, does the Fed get ahead of the game? Has the Fed ever had a history of being ahead of the game, trying to cut rates before a recession hits, for example? We're trying to raise rates before inflation starts to rear its head. And if you look back in history, there's not really a good precedent for that. So what do we need to do with that? We'll get back to that stuff. Taylor Swift, I think, put it best. We need to calm down. Now, I didn't know she was going to write this song and do this when I was first asked if I could come on and talk about the markets, but it was really appropriate that it came out just this past week. We just need to calm down a bit. We don't need to have a Fed cut right now, even though the market's pricing it in. So with that backdrop, low inflation, strong employment, earnings still rising, but at a slower pace. The market is still pricing in an 80% chance of a cut by July. And what is the consensus today? The consensus today is that the Fed statement removes maybe one word from their policy statement that says that we're not going to be patient any longer. So how has the market been adjusting to that? If we look at the CRB index, and every one of these charts I'm going to show you today is a monthly chart, so it's a very long-term view. The CRB index has really been doing nothing, moving in a range for the last 3 years. What is it doing short term? Short term, it's been falling, and that's a good thing. That certainly bolsters the case that the market is presenting, that it's time for, or that it's appropriate, it's possible for us to have a rate cut. From a technical perspective, you see in that CRB index since this time last year, a series of lower highs and a series of lower lows that we're starting to head down towards now if we keep going. So inflation is in check. So maybe the Fed doesn't have to be as aggressive about controlling interest rates. And that's a good thing for those that are looking for a rate cut. When we look at some of the pieces underneath there, you know, some of the markets that people follow, the copper market. This is showing the same kind of reactions that the inflation market has shown. You know, we've got the top there in 2011 and a series of lower highs. Solid bounce in 2016, but from the retest of that rising trend line in 2017, the copper market has been weak to flat, hovering right around its 200-month moving average. What does that tell you? There's not really pressure on things like maybe the housing market or the building market, where a lot of copper is being used. If we look at crude oil, the crude oil had a strong run up from 2016 when the Fed started tightening rates, and looks to have stopped just before they started to back away. But that's also a lower high in crude. The rebound back down to support just over $40, around $45 at the start of 2019. Shows us that we've got another lower high in there. And what's most important to me here, a failure to break above this 200-month moving average. So long term, not so strong. You'll see that I use RSI and MACD are really the main two indicators that I use on my charts, and it's showing the same thing there. A lower high in the RSI and barely breaking above the 50 level. So oil is in check. Oil has been the past 4 or 5 months having a fairly strong correlation with the stock market. What else is going on around the world? Well, you've got other stock markets. You've got the Tokyo Nikkei average hovering at highs, at multi-year highs, at 20-year highs. Pulling back slightly, but still more of a consolidation than a reversal. So strong growth in the equity markets continuing, with maybe a little bit of retrenching in the world market. But is it just Tokyo? The German market is maybe a little bit weaker. We saw it top out in 2017 and pull back. But over the last 6 months, it's been strong and now consolidating. Is it waiting for Draghi to cut rates, or is it waiting for Powell to tell us what he's going to do? It's certainly not, rocketing one way or the other. Then one of my favorites, the Chinese market, the Shanghai Composite, has gone through, had that massive pullback in 2009, 2008, barely recovered from that to then come back up to a top in 2015, but it's been making a series of lower highs and lower lows since. A rough market. China has been having a really hard time, and is that going to be a big impact on what happens to U.S. policy? All these things at some levels are interlocked. So if we move beyond world markets then and look at something like gold, what is gold telling us about the state of world markets? Well, when I look at this chart, the pullback I see there, a 50% pullback of the move higher from 2000 to the top in 2011, and then virtually no bounce. Just a solid flat line hovering right around that 38.2%, that key Fibonacci level, and been sitting there for 3 years. Is gold showing that the dollar is going to head one way or another, or is gold showing that inflation is moving one way or the other? It's really telling you that we're in kind of like this Goldilocks environment where nothing's happening. No strength and momentum. It's failing to get above 60 on the RSI, and you see the MACD is hovering right around close to 0. What about the dollar index? Yeah, I've seen that the dollar index tends to move in 7-year cycles. We had from 2002 down to, or late 2001 down to early 2008 as a major downtrend. And then 2008 through to 2014 as a kind of a sideways move. We had been in this upward trend, and then all of a sudden it stalled out at the end of 2016. Well, what happened at the end of 2016? Well, we had an election, if you might remember, and the whole world changed at that point from an expectations perspective. But if you take that 1 year out, 2017 to 2018, the dollar has been strengthening since then. But where is the dollar right now? It's just hovering right around this 97 level. Longer term, it's been between 90 and 100 for 5 years now. Not a whole lot of change for a discussion of are interest rates going to be moving higher, or interest rates going to be moving lower, or are they going to be moving sideways? What has been making a really clear statement, though, is Eurodollars. Eurodollars, you can see the start of the tightening cycle up here towards the end of 2015 as Eurodollar prices started moving in line with interest rates. And then that pause as the Fed slowed down into 2018. As we moved through 2018, then we had the surprise tightening in December that brought us to the bottom, and the Powell reversal. In January, we came out and said, well, I'm not going to say I made a mistake, but we're not going to be tightening anymore. We're not going to be running off the balance sheet. We're not going to be doing quantitative tightening. This, I think, is the most interesting aspect of short-term rates. So despite Powell saying that we're going to pause, the market did a total reversal turn. And instead of saying, pause means moving sideways, the market has said pause means we're going back the other way. So is it just the market being a forward discounting mechanism? It could be. We saw the same thing happen, though, in 30-year bonds. Here's just a 20-year price chart of 30-year bonds, but you could take that back another 10 years and you'd have that same rising channel. We had the little breach of it towards the end of last year. And it's kind of a false breakdown with bond prices moving back up now. And almost at the point now where they're retaking the 2017 highs. So bond prices, you think about bond prices, you think about risk-free rates plus inflation premiums, long-term and long-run inflation premiums. If inflation, as we said, is falling, that's certainly more of an indicator that bond prices, which are inverse to rates, so rates would be falling with bond prices rising. With inflation falling, it's questionable whether bond prices are rising and rates falling because of lowered inflation expectations or because of lowered interest rate expectations from the risk-free rate. But it does fit a case where lowered short-term rates do fall into play. What does all this mean? All this means to me that this chart of the S&P 500 that's been my guide for the last 10 years is continuing to play out. And yeah, I'm not a huge Elliott Wave guy, but some of the aspects of Elliott Wave have played out very well here since the 2009 low, with what I counted as a five-wave move within the third wave that ended at the beginning of 2018, and a correction that ended wave 4 of that at the end of 2018. So by my count, I see that the fifth wave of the positive factors here has possibly phased out of the first run of that wave. So I marked a 1 on there at the end of April. The question is, have we flipped the switch now, and can we draw a 2 down here? And that's what everyone's playing for today, right? We've got the Fed now. All of this leading up to the Fed is expected, according to market expectations, to do something to indicate that they are ready to lower rates in the short run. So sometime in the next 6 weeks. With that, stock prices have been moving higher in June. Bond prices have been moving higher in June. And gold has been moving higher in June. Can it all go up and continue to go up? One last chart I wanted to show you is, because I know the Elliott Wave can get pretty complicated and lots of people can interpret it a lot of different ways. One chart that makes it a whole lot easier to interpret what's going on in the world, at least in the stock world, is to look at a Renko chart. I like to think of Renko charts as a combination of a point and figure chart and a candlestick chart. So point and figure from the perspective that we don't print another box, or brick as they're called, until the price of the index or whatever we're measuring moves outside of the box size. And the box size here on this chart is the average true range over a 14-day basis. So for me, it's here 29.95 S&P 500 points. So just under 30 S&P 500 points. So as of the close yesterday, Renko charts were telling you that the S&P 500 is still a buy. So how do you position for this now? You've got expectations that the Fed is going to change language so that they can cut rates. I don't think that there's a whole lot of faith that the Fed will cut rates in this current meeting, but the expectation is that they will open the door so that they can do it in July. Back away, though, to December, when the expectation was that there was going to be no rate hike, and Chairman Powell still managed to shake the market by calling for and actually raising rates. So we've got real examples of the Fed moving separately and diverging from what market expectations are. Different interpretations of what the economy actually looks like. You know, we still have the Federal Reserve bank offices, the regional banks, coming up with GDP estimates around 2%. So this is not recessionary. There's not really a need from that perspective to cut rates unless you think that you need to get ahead of that perspective. And with all that, the market has priced in higher stock prices, higher bond prices. So the market has certainly been pricing in, from a bond market perspective, rate cuts for a long time. And now it seems that the stock market is starting to price that in as well, as earnings are slowing a bit. So what do we do with that? Well, clearly you have to be long, positioned long in this marketplace. But you need to have some protection for that, aspect that Chairman Powell goes against what's happening in the broad market in terms of expectations, again, at this meeting. So how do you do that? Well, from my perspective, I'm an options guy. I think you noted in the beginning that I wrote a book called Trading Options, where I use technical analysis to do this. For me, it's a matter of looking at what the potential moves are in the stock market, and buying puts or buying put spreads to participate in the downside if there is a pullback because the chairman disappoints, but managing to stay long as well. So I guess to sum up my perspective here, we've been in a long-term tightening cycle that clearly ended in December when the chairman tightened rates and then backed away from a promise to raise rates again. We've got a market that's taken the interpretation of that to say that the tightening cycle has ended and now we're going to be into an easing cycle. But no firm commitment from the chairman that they are doing anything other than just waiting and seeing. So the typical data-dependent view. So you would expect then that anything that goes away from the ability to allow the Fed to ease in July would be a disappointment to the market as it's kind of run past the flat line perspective and moved to the easing perspective. So I would suggest that if in the next hour and 15 minutes, if you have not done something to either hedge some profits or put some protection in place, that you've still got an hour or so to do it. And that's what we've done for our clients and our portfolios as well.
Very good, Greg. I got a couple questions for you. I know, well, at least based on what you were just showing on your charts there, especially with that Elliott wave, looking at another big move potentially in the markets, is that helping to drive your portfolio management, believing that the overall direction in the U.S. equities continues to be higher? And if so, what are you positioning in, not just ahead of the Fed? I mean, that's a short-term thing, but more long-term. Are you looking at relative strength to help you in various sectors? How do you take this information that you just presented to us today, and how do you then go to the next step and say, okay, this is what I would be interested in owning going forward?
Yeah, so from here, I take two steps. I look at this as the first view to determine which way the trend is. And as I guess I made clear, from my perspective, the trend remains to the upside. With that information, then, I have a universe of about 1,000 stocks that I break down not into straight sectors according to the classifications, but sectors like commodity, industrial, machine-driven sector, financials, pharma and healthcare, tech, and then I lump a whole lot of other stuff into retail. And I'm looking for, which one of these is actually performing the best. And I look at every one of those charts, every one of those 1,000 charts, at least once a week to determine, what's going on. And I'm an old school guy. I've been doing this for 30 years, so I'm handwriting these names in a notebook. And for me, then it's real easy. I see that when I look at the 1,000 charts, if there's 60 that look good in the finance sector, then that's where I'm going to focus. If there's only 10 in tech or 5 in healthcare. Lately, probably to no one's surprise, tech has been the hot spot. And over the last month or so, healthcare has been turning around and showing up a lot more often as well. I'm looking at those stocks from a technical perspective. So I presented some stuff here that looks at Elliott wave, but I use classical patterns and I use Fibonacci analysis. And I'm looking for a confluence of different types of technical analysis to drive multiple forms that are showing that a stock is ready to move. Mm-hmm. And then when we get into these uncertain periods, it's where I use the options information that I have to put an options overlay on top of that, so that instead of, say, buying MongoDB or C's, which has been the hot software sectors within tech, I might buy instead call options on those stocks that go out a couple of months to be able to ride the momentum waves as they move higher, but to limit the amount of capital I have at risk. Mm-hmm. So if you look at my portfolios, I'm about 80% cash right now. Yet my delta in my portfolios is over 1. So I'm outperforming the market with 20% money invested, because it's all been levered through options.
Mm-hmm. Do you have any options that you use to protect your portfolio in the event that we do have some kind of a market meltdown?
Absolutely. I'll tell you the most recent trade that I put on for clients was I put on some put butterflies 2 days ago. Should have done it yesterday after that big move yesterday, but I did it 2 days ago, where I'm protecting for a drop down in the S&P down below 2750. So if it moves down to 2750, I'll pick up some good protection to the downside. And if it moves below that, my protection starts to fade a bit. And that's very short-term protection for this statement today. Longer term, I've got S&P put spreads and what are called 1-by-2 put spreads, where I buy one put and sell two lower ones as longer-term protection through the end of July as well.
Is there any particular reason? I mean, it sounds like you're pretty bullish that you think the market's going to go higher, although you're trying to protect yourself to the downside. But is there any reason that you're only, that you've got 80% cash? I mean, granted, you've got the leverage there to kind of make up for some of that, but is there a reason why you wouldn't be more invested given your bullishness on the market potentially going higher?
Yeah, well, some of it is that the sector that's been leading the way has been tech, and now starting to see more healthcare as well. And those are have tended to be playgrounds for momentum traders. So there's a lot of liquidity in both the stock and the options in those markets. And since neither one of those sectors hold a lot of stocks that pay dividends, there's really no reason to buy the stock. So this is not this capital gains treatment that you're looking for in terms of or dividend treatment that you're looking for from holding for long periods of time and collecting the 3%, 4% dividend, whatever it is for some of these stocks. When the dividends are really low, you can get just as much benefit from a move by holding the options with a lot less risk. Usually 3 to 5% of the price of the stock to buy the options. And if you're not going to give up a 4 or 5% dividend, then it's an easy thing for me to look at.
Mm-hmm. Well, I've got one more before we wrap up. I do have one more chart that I want to pull up and show you and get your comments on. Before I do that, is there, I see your website there at the bottom of the screen, dragonflycap.com. Is that where folks should go if they want to learn more about what you do?
Yeah, dragonflycap.com. Where is this? There's a page on there about that talks about more of this in detail, about how I get to these 25 to 35 trades a week. And I've got a special code set up now for a $150 discount for MarketWatch Live people here if they want to get into there. But dragonflycap.com is where you'd find this.
Awesome. We appreciate that discount too, for sure. So if you're interested, make sure you take advantage of that. All right, I'm going to show you a chart, and you talked a little bit about the dollar, and I'm kind of watching to see what happens here with the dollar because of its impact on a couple of areas of the market, namely energy and materials, which you also talked a little bit about earlier as well. But, we've gone and some of the watchers here at Market Watchers Live have seen this before. It's a little bit of a refresher, but I just want to get your take on it. The dollar, when it was downtrending during the last bull market from 2002 to 2007, had an impact that was obvious. And not only did energy go higher, but energy versus the S&P 500 went higher. Not only did materials go higher, but materials versus the S&P 500 went higher. So we were seeing a lot of relative strength in energy and materials while the dollar was in that decline. The last 8 years, however, and you pointed this out, we've been seeing the dollar rise, and we've been consolidating. And so the group energy has gone higher and materials have gone higher, but on a relative basis, if your goal was to outperform the S&P 500, this rising dollar environment has made it very difficult to do that if you're trading a lot of energy and material stocks. And that's what this downtrend, this 8-year downtrend has been. So here we are sitting still in this uptrend. And even recently, I mean, I've talked a lot about the fact that materials have had a nice little pop back to the upside recently, but on a relative basis, they're really just kind of going along for the ride with the S&P. I think it's going to boil down more to where this dollar goes from here. So I guess my question after all that rambling is, do you think would you continue to treat this dollar in an uptrend until it's not?
Yes, I think I would continue to treat it as an uptrend until it's not, especially from that perspective. But taking it kind of a step further then, that if you look at inflation, so dollar and inflation are tied to each other, right? Mm-hmm. A strong dollar means low inflation. Low inflation means low energy prices, low commodity prices, and that's what you're seeing here is being reflected, right?
Mm-hmm. Yeah, I think that's what's really putting the pressure on the Fed to lower rates, because if they continue to raise rates and continue to strengthen the dollar, that in essence is continuing to put more and more downward pressure on inflation. And I think the market would much rather have inflation problems than deflation problems. And I know that deflation hasn't been we haven't talked about it a lot, but I've been seeing some reports that have been coming in below the Fed's expectations, and I think that's what's really giving them the incentive to lower rates next month. I don't know if you have any final comments on that before we move on.
Yeah, I mean, it's certainly a case that they could, that the Fed governors could start to make. That we have been data dependent, and towards the end of the year last year, we thought that the data was still showing inflation picking up. Now we're not so sure about that, and the data is now starting to show us that it's actually not picking up, so that this is not a typical environment where strong employment leads to inflation. We're not seeing the inflation part.
Yeah. What I guess doesn't really matter which side of the camp you're on. In about an hour, it's going to get pretty exciting when the Fed either. I don't think they're going to lower. I kind of agree with you. I think they're going to change their wording. I think they're going to try to let the market know that basically next month it's a foregone conclusion. They're going to cut. I think that's what the stock market is expecting.
Yeah, it seems like what they expect, and if that's not what we get, that's the reaction to that will be the interesting part.
No doubt about it. I don't know if I think I want to go golfing or something. I don't think I want to watch it this afternoon if they go opposite what the market's expecting at this point. But it was a great pleasure having you on here today, Greg, and we certainly look forward to having you back soon.
Thanks for having me. It was good fun today.
Yeah, a lot of fun. All right, take care, and we'll get you back on here soon. And Erin, if you are ready, why don't we just go ahead and move into the RRG?
All right, there it is. All ready to go. Thought I'd animate it a little bit today just so you could see the move since December. What we have looking up right now is technology. Everybody wants to know about technology and discretionary. That, those being those aggressive two sectors. I think it's really interesting when we see the shift on what everybody wants to look at. So we'll go ahead though and get started with KKR.
All right, KKR, the first 10 in 10 stock. I'm looking at it. I just see consolidation. The group has been very strong that it's in, and as a result, all this consolidation in the stock has really not been good because on a relative basis, you're looking at a laggard. So I don't see any reason to get into a stock that is underperforming its peers and has been for quite some time. I think there's probably a couple levels to watch. I would say to the upside, you want to watch that 25 area. To the downside, we've had multiple tests around 22. So I simply think you're just in a trading range. And again, when you've got a group, it's peer group that keeps moving higher, and you own a stock that is just simply going sideways, it's very frustrating. And to me, tells me that this is an area Wall Street, or this is a stock that Wall Street's not really, confirming as a leader. And as a result, I would stay away from it, look for something else in the group.
All right, and the most popular in the chat room is XBI, the biotech ETF.
Yeah, biotechs, I've kind of got my eye on here because I think they're starting to show some life. And we know historically, we've talked about this, June and July is when this group tends to really move. And you can see on the chart, actually, let me put it on a different chart here. I think you're going to see it better here. I think off of this uptrend, I mean, maybe this is a cup. Hard to tell how it finishes. But what I do know is look at the volume, the interest coming in the last couple of days as we've moved through both of these moving averages, and check out the PPO moving back into positive territory. So I think the combination of both of those has me much more interested in this group at this point. And what I would simply do to the downside is just make sure that if we are in an uptrend, now we should begin to see this 20-day moving average hold as support on pullback. See how we kept failing during a downtrend? Well, if you're uptrending, you should start holding like we saw back in January, February, and into March. So I think we've now got an uptrending stock until area of the market, an ETF, until proven otherwise. So I've turned bullish, and I've actually started to buy some of these biotechs.
All right. The next one I'm going to give you is PayPal.
All right. And by the way, that was also one of Greg's points today. He was seeing strength picking up in healthcare.
Mm-hmm.
All right, PayPal. I love the stock. I'm going to put this on the relative chart because it's been it's been a leader. It's included in software. I mean, it's like a financial administration / software stock, but beautiful move up. Software has been moving up. This has been one of the leaders. Really difficult to grow bearish a stock like this. What I would simply do is I would be continuing to buy or add. If I'm already in it, just hold. as long as it's above that 20-day moving average and above the price support there. That was the prior resistance at about 114, 113 and change. We got up to 118 and change. Now we're working our way back a little bit, but the overall uptrend remains in play. I think this is a nice looking chart.
All right. Let's see. Next one is Baidu.
Oh, bad. I haven't looked at it in a week, so let's see what it looks like now. Well, we're starting to strengthen a little bit, but I think we're just getting an initial test. Look at the volume on this strength, if you want to call it strength. Actually, there's almost been no relative strength. So essentially what's happening is the internet stocks had a huge bounce in June, and so Baidu is kind of hanging on to the shirt sleeves, everybody else in internet that's pulling the stock up a little bit. But I just see a lot of distribution in this stock. No relative strength, nothing that I can really sink my teeth into that I would want to be interested in owning this stock. I think the first thing is to get through the 20-day. If we can do that, and that's a big if, I think we still got issues trying to get through that gap resistance because of the heavy volume right here. And then, of course, there's a 20-day moving average. But I think even if we get through and we get to 130, I think Baidu is going to struggle. I have no interest in this stock at this point.
Okay, no interest. Well, are you interested in Overstock right now?
This is another one that's been downtrending. I mentioned this one as part of the cryptocurrency area that I talked about, I guess, yesterday. It's trying to get through the 20 days. So I do think in the short term, it's beginning to show some strength. But just again, if I took a chance, a flyer on a stock like this, because it has been such a horrible relative performer, I'm going to keep my stops very tight. So if I looked at this stock and I said, hey, it's breaking through the 20-day moving average, and I'm going to jump in, well, if it closed back below the 20-day moving average, I jump right back out, because we have seen this before. I mean, if you go back into early May, started to see some movement to the upside, and we had volume back then too, by the way. Couldn't sustain it, went right back down to a new low. What I don't want to do is hold a stock like this and pray for a bottom, because that can lose you a lot of money, especially if you're a momentum trader and you're trying to make money on the long side. So I just say this, if you like the stock because it's starting to show a little bit of strength here, just keep in mind specialty retailers have been showing strength. And even with that, this stock continues to underperform. So if it doesn't break through the 20, you don't have a whole lot to hold on to here. So I would pass on Overstock at this point.
Okay, our only utilities request Vivint Solar VSLR.
Yeah, well, first of all, I love the group. You can see the group down here has been moving to the upside, continues to break out. It's done pretty well, even though it's in a conservative area of the market. It's done pretty well versus the S&P 500. I don't know this company very well, so I'm going to assume that it's probably a smaller company, maybe small cap, so keep that in mind. But yeah, I mean, it's hard not to like a stock that yesterday closed above the 7.25 level for the first time in a year. We've had a lot of tests here, but we finally did it. Look at the volume coming in to support it. So I think you got a nice uptrend here. Maybe watch that 20-day moving average to the downside, but I don't really see too many negatives on this chart. I like it.
All right, let's see. The PMO just went positive on this one. Kronos Group, CRON.
All right. Well, my guess is it's going positive from underneath the center line, just looking at the chart.
Indeed.
Yeah, I'd like to see it. I want to see it hold this recent strength. So because it's been a relative laggard, and again, you can see that on all these relative charts, I would be looking at the recent lows and making sure that I keep my stop in play. I think if the stock closed below 15, I'd be out because it's been such a laggard of late. I thought that 14 was the level. That was the breakout right in here, if you can tell. We went back, tested 14, started to bounce. We had one day we went just below and came back up above. So maybe if you want to give it a little bit more room, let's call it 14, but that 14, 15 level needs to hold.
Okay, next one up, and I don't know about you, but I don't like this chart. AAXN, Axon Enterprise.
All right. I know I used to like it, but it's been a long time. So
yeah, it's not looking too good right now.
I actually do like it.
I love it.
I mean, I'm just looking at the relative strength, which are all pointing mostly from left to right, moving higher. It's in the defense industry, which I really do like. The group had been on a big run. I think that's why we saw some weakness. But I like this reversal. That's a piercing candle off the 50-day moving average, and the volume is pouring back into it. So I actually do like the stock because I like the defense industry. And what I would say, though, now is that with today's open and maybe with this other open back here, that is an area of support that I wouldn't want to lose. I think testing the 50-day and bouncing off of it is fine. If we were to go back down and lose the price support and that 50-day, then I'd begin to have to, reevaluate things. More than that, I'd be probably getting stopped out of it. But I think the stock goes higher because I do like the group, and it has been one of the better stocks in the group.
All right. Next one is OSI Systems, OSIS. Mixed reviews for me on this one.
All right. And even on that AAXN, I mean, for those of you maybe that are new to the show, Erin and I look at the stocks a little bit differently. I know, Erin, you used that PMO, and I'm sure because it had such a big run, it got very extended on the PMO and has probably started to roll over. And that you see a lot of times when you consolidate. So that's a stock that may go through a period of consolidation for a while your PMO moves back down to the center line or close to it. And then when it starts to turn back up again, it could be a stock that you then like.
Exactly.
So sometimes after big moves, either up or down, I think that's when we have differences for the most part. OSIS, I like the volume trends. I like the relative strength on the stock versus the group, but look at what the group's been doing relative to the S&P. So I would tend to agree with you. I think there's some mixed signals here. I think as far as this chart goes on an absolute basis, I mean, we're just seeing move higher after higher highs, higher lows, higher highs, nice volume. For me, it's a little extended. So I don't know that I would want to jump in here, but I think a pull back down closer to that 105 level, or at least down to the 20-day moving average would start to make a little more sense.
All right, our last one is going to be Floor and Decor, FND. Nice little cup going there.
All right, FND. Yeah, I think maybe off of this uptrend. This big heavy volume gap down, we couldn't get back through 44. So I think that's going to be the big level I'm watching. I'm seeing kind of a mixed picture here looking at these various relative charts. So I would say that to the upside, I'd watch a breakout above 44, I think would be very bullish, while to the downside, we want to make sure we hold on to 35. So that's the trading range that I see here in the near term.
Okay, and that does complete the 10 and 10. Here are the symbols we just went over. If you'd like to see those annotated charts, just go to the Articles tab, click on the MarketWatchers Live blog, and the link to that live chart list is right there at the top. All right, I'll be back with the final market update. All right, it is time for our final market update. Let's see what's been going on. Not a whole lot. Clearly, the markets are a little bit nervous before this Fed announcement coming out. The Dow is mostly unchanged, but up a little over 10 points. S&P 500 is down 0.03%. NASDAQ, again, seeing most of these traveling sideways, a little bit mixed with the NASDAQ lower and the NYSE slightly higher. Russell 2000, we're seeing the same sort of action sideways, but on the negative side. Canadian markets are positive, but also moving sideways. Treasury yields are up today, 2.091%. The VIX is rising, currently at about 15.5. UUP, excuse me, is down for the day, down about 0.25%. And gold is also lower, but it is trying to make a comeback, likely because we're seeing that the dollar falling. USO is lower on the day, down 0.64%, reading 1118. TLT is down, not surprising, with the Treasury yields up. And let's look at our sector summary. What is moving the markets today? Well, let's try that again. All right, financials are leading right now. Materials are the losers of the day so far, down 0.86%.
All right, we do know that it is Fed Day, so I just want to give you a level here on the NASDAQ that I'll be watching to see if we close above. I think we had off an uptrend, nice little inverse head and shoulder pattern where we took out the neckline around 7,900. We can get very volatile after the Fed announces. If they come out, they do get rid of the patient wording. We might see an initial pop and then a sell-off and then another rally into the. It's really difficult to say where the market goes in the last 2 hours. But what I would be focused on in the short term, for me anyway, is whether or not we can close above that 7,900 level. I think if we do, I think this is a pattern that looks very bullish to me. I think we could make another run up for that 8,150 area to test those all-time highs that we saw at the end of April. So let's go ahead and move on to our final segment. And our last two segments are going to start off with crossing lines. And crossing lines, what we look at on the charts, obviously, are a bunch of crossing lines. So I'm going to let Erin go ahead and get started with this. What are you seeing in terms of crossing lines on your charts?
All right, so I did a search on PMO crossovers based on the last couple days. And interestingly, a lot of times I try and go in before we get the PMO crossover buy signals, but today I wanted to look at those because we're crossing lines. And what you'll find is even if we wait for those buy signals, you sometimes will get in on that little pullback after we get the turn in the PMO. And I think Celgene is a perfect example. Here you go. We got the breakout as we had the PMO buy signal come in. And now we are up on the day, but we're slightly lower. So we might be seeing a little bit of a pullback after the breakout that we saw yesterday. Next one up is Ellington Financial. And here you go, PMO buy signal is intact. We've gotten the breakout. In this case, it is up 1% currently, but it could see a little bit more of a pullback. But once you get that breakout and a nice healthy OBV, I would be looking for higher prices. And Manpower Group was another one I saw. PMO buy signal. The scooter has moved into the hot zone. We see this bounce right off that 200-day EMA. Short-term breakout. Next area of overhead resistance would be right about, it looks like a 96, somewhere in there. So that one I thought was interesting with the crossing lines. Next one is Rapid 7. And here you go. We've been in a consolidation zone and we are near the top. But notice this is the first time we've actually gotten the PMO crossover. It's happening in oversold territory above the zero line. That's what you want to see. It's better that it not go into negative territory. It tells you that it's got internal strength and relative strength looking pretty good here on the scooter. It's been in the hot zone pretty much the entire year. So I would be watching for that breakout just because we finally did get that crossing line. We finally did get the actual PMO buy signal. Vernet X, I see of course, there's a signal, and I'm looking at an ascending triangle, bullish pattern, should expect the breakout to the upside, and your overhead resistance just above $7 on this one. And then finally, V-Ray just got the PMO buy signal. Notice OBV is rising slightly with price bottoms. And now we're seeing an OBV reading that is higher. And that does confirm this breakout that we're seeing right now on V-Ray. Those were the ones that I had. What do you have crossing lines?
Okay, well, I'm going to, basically what these are going to be are going to be the crossovers of the PPO over their trigger line. So in other words, the PPO is the thick black line that measures the difference between the 12 and the 26 period, or in this case, day exponential moving average. And then this red line here is the 9-day moving average of the PPO. So a lot of traders will use this cross as an indication that we're moving from downtrending back to uptrending. Now, I'm going to maybe just add a couple things here because I want to be real careful when I assume that the crossover means that there's been a change in trend. So here with MRCY, you can see we're still trading below the 20-day, which is below the 50-day. All of the, after we gap down here, you can see the reaction high has been up near 70. The 50-day moving average is sitting at 70.06. So even though I'm getting this crossover, I have a lot of work to do still technically to get back up above these prior levels. So I don't For me, just seeing the crossing line is not enough. I want to get that price confirmation. So to further illustrate, let me look at just a couple of others here. And it's always helpful if I type them right. So Autodesk is another one where we're seeing this cross. And by the way, if you're looking at these and you can't quite tell if they're crossing, you can tell by looking at this histogram. So if the histogram has the bar above 0, that means they've crossed to the upside. If it's below 0, they haven't crossed yet, or they've crossed to the downside. But take a look here. Again, you've got gap resistance near 170. You've got a 50-day moving average, 169. You got a recent price high around 168. This is a key overhead resistance. So if you're trading just based on this crossing of the line, I think you're setting yourself up potentially for a problem. Look at what happened just a week ago. Same setup. Autodesk was crossing over from underneath just as we hit a short-term top. The stock lost $10 in 3 or 4 days after that. So I think you want to be careful, especially if you've got if you're on the long side and you've got a PPO or any kind of momentum oscillator that's below 0. It's telling you overall that you've got negative momentum in the stock. And what a crossover is telling you is that your momentum is slowing to the downside, but it is not necessarily positive. So I like to get that confirmation with price. PSEC, another one, same thing. Here you can see, tried to make the crossover, actually did just before about a 6% drop to the downside. Now here we come back up again. So these are all showing crossing lines, but I think a lot of times it's more than just that. Last one is Beacon Roofing Supply. Same thing here. This one is much more definitive. It's been well below. Now it's just crossing, but I'm seeing what could be a false breakout above that 20-day moving average. So crossing lines are a good thing, but I think they also require, in my opinion, confirmation on the price chart. And so that is something that I would focus on as you could try to get better and better in the trading world. Okay, last segment. There's your summary for crossing lines. Our last segment today is going to be Scooter Report, and we do have a poll. If you haven't completed it, you've got time, go in and complete it, take a look. See, we want to know how you use the scooters here at StockCharts. It is an exclusive feature. I think everybody I know, all of my fellow commentators have used the scooter at one point or another. I know, Erin, you keep it on your charts. Greg Schnell uses it a lot. Of course, John Murphy developed it. I use it many times. Well, I'll talk about how I use it in just a couple minutes. But what are you using today in terms of showing the scooters?
All right. Well, I decided to go to the scooter movers on our homepage, right there on the member homepage. And I thought I would look at a couple of small cap, mid cap, and large caps. So you can, of course, arrange them by the highest scooters or the lowest scooters, but I like to look at top up, which ones are the big movers. And the way I look at them to see all of the information, the way I like it is using my candle glance. I think everybody knows how much I use this. I set up my own style. These are the intraday charts that we have when I do my MarketWatchers, but I'm going to go to the other one that I use on my regular account because my candle glances are set up exactly the way I like them. So let's start with some small caps on candle glance. And there you go. What I look for on these scooter movers, something just like Rose Hill. This is perfect. You're seeing that PMO moving upward, hasn't quite given you the buy signal, but you know that scooter is making a huge improvement right now, and that is telling you something. So I would just go in and look at your regular support and resistance here. And right here, I'm looking at these tops and the low here in the short term back mid-May. That's where I'd look for my resistance at this point. But everything it's telling you as far as the PMO and especially that scooter, the things are looking good here, and you can think bullishly. All right, let's go on back. And what would be another small cap that looks interesting to me? Well, I'm not seeing anything I really want to look at right now. So let's go back and look at some mid caps. I'll do the same thing, pull him up and then right here. And you'll see some of these are repeats of some of the stocks we have looked at because of the fact that, you know, they're making those big moves. You've gotten upgrades or earnings or that sort of thing. So you'll see a lot of similar stocks, of course, in that scooter mover area. So what do I want to see here? Again, I like to watch for that PMO and some breakouts. I mean, these are really great breakouts here. However, you know, I'd want to wait for the pullback. So if I'm looking at something, you know, real time, what I want to look to, I would say either this Charles River or PLDT, mainly because you're getting a move on the PMO turning up. This one already has the buy signal and it's an oversold territory. And today, actually yesterday, we got that breakout. This looks sort of like a V bottom with that pullback to the 200-day EMA. Beautiful look, nice breakout. Let's go look at the large caps. All right, and I had picked out, let's see, I know I had picked out T-Mobile. So let's see what it looks like amongst its peers right now. So there is TMUS right there. I thought that looked good with that breakout that we're seeing actually trading above. So let's look at T-Mobile real quick. All right, so there you go. We're seeing that PMO. Now, we had a fake out before, so you'd want to probably pay close attention to see if this turns out to be one. But notice there was a lot of twitch on that move back up. We're not seeing that. We got the nice V bottom on the PMO. I would be looking for that upside crossover. Look at OBV volume. Nice volume coming in on this short-term rise that we're seeing. Did trade above this short-term overhead resistance. I think that one looks pretty good, and I don't know that there were any others. We already talked Adobe to death, so I'm not going to do that one. I think I'll just give it back to you, Tom. What are you looking at?
Okay, well, the first thing that I want to do is go in and just show you. Let's say you're looking at a chart like the S&P 400 mid-cap index, and you like something about this index. You see the breakout here above the 50. Maybe it's the PPO going above the center line, and you're like, okay, this index is doing well. I'd like to find some of the leaders in this index. So if you go into your dashboard, and by the way, this is a reason if you're not a StockCharts member to try it. I'm going to show you real quickly how you can go in and add a new list. So I could go in here and add it. Now I'm going to cancel because I already have added it. I added this 1300 S&P 400 mid cap, and you can see right now there's 0 charts in there because I haven't added anything yet. So let's go up here and let's run a scan. And I'm going to do a new scan. And I don't need any of this stuff. I'll just get rid of everything there. And let's go down to indexes. And here you can see different indexes. Now, you can only download up to 500 stocks. So you can do the S&P 500. You could do the NASDAQ 100. You could do these Dows, the different Dow indices. But I'm going to pick this S&P mid-cap 400 and add it. And by doing that, now you can see the group is S&P 400. Check syntax, which should be fine. It is. I run the scan. And all of a sudden, I have 400 stocks. That's shocking. It's the mid-cap 400. So I've got actions. I'm going to replace an existing chart list with these results. I'm going to go down to that 1300 chart list that I have there. Okay, boom. All of these stocks now are going to be downloaded into that chart list. 400 stocks, basically about as fast as you can snap your fingers. Now look at it. I've got it sorted by scooter. Now, sometimes you might not see this scooter show up on your list. So it might be that it's not showing. So you've got that column. So let's say you look at it and you're like, I don't see the scooters on mine. Where are they? Make sure you go back to the columns, click on scooter, and then it magically appears. And now, let's say it was, I don't know, maybe it was sorted by sector. So you're not in order here. All you do is click on scooter. And now it's going to give you the list of all 400 mid-cap stocks in scooter order. So it's already telling you which stocks look good. Now, some of these I know were buyouts. I know Cypress. I know Sotheby's, Versum, maybe a couple others in here. So I'm going to go through and skip those and just pull up the stocks that I think look best in terms of these stocks. So the first one here is OLED. So quickly you can see, all right, we consolidated, nice move up. Look at yesterday, breaking out to a new closing high, great looking PPO. So this is one that certainly I would be interested in. We go back, and I know the other one was Tree. Well, there it is. All right, Lending Tree. Well, look at this. Moves up, pulls back, tests the overhead resistance, pulls back, bounces off the 20-day. Look at the volume pick up, and off to the races we go. Volume, a little bit of an issue for me, but hopefully you can see technically it still looks pretty good. The next one up that I put on my list was MKTX Market Access. Here's another one. Look at this move to the upside. Heavy volume, pulling back, getting close to that 20-day, now starting to strengthen again. Another one that looks good is SMG, Scott's Miracle Grow. Beautiful move up, pull back, rising up. PPO looks good, but you kind of get the sense of how quickly you can just, I went from nothing to all of a sudden having all these stocks to trade off of. I wanted to mention one more, and that's Eldorado Resorts. This one has a pretty nice scooter. It was a little bit lower than some of the others, but it was still pretty nice. The reason I wanted to mention this one is look at it breaking out above all of this consolidation, and it's in the gambling index. So the gambling index, if you take a look at it, has not been a very good index relative to the S&P, but ERI has managed to be a great performer. So in June, as the gambling stocks start to move, you can see what's happening here with ERI. It's moving, and it's leading, and it's breaking out. So that was just a quick analysis. We can bring up the summary here of how you can use the scooter reports. Erin showed you from the top 10 list using Candle Glance. I showed you how you can just take a whole index and literally in 3 minutes or 4 minutes, downloaded it into a chart list, sorted it using that summary function in the scooter column, and then quickly went down and looked at individual stocks to find trading candidates. I think it's amazing, and combining all the features and tools here at StockCharts definitely will improve your trading. If you're not already a member, you should be one. All right, here we go into the poll, and I wanted to see how everyone used scooters, and I don't know, anything strike you here, Erin?
Honestly, the fact that they use them on their charts. I know a lot of people will use it as a reference, but I didn't realize that many people actually had it in their chart style. Hopefully it's because I do.
Yeah, I mean, well, that's certainly one reason too. I know Greg Schnell also uses it in his chart styles. I refer to it. I mean, I use scooters a lot. I don't have them on my chart because I like to conserve my real estate space for just a couple of things that I really like to focus in on. But I think that it's really important, the messages that scooters gives you. If you don't know anything else about relative strength, scooters essentially they're putting every stock by market capitalization in order for you in terms of relative strength. So it's a brilliant concept. And hey, if it was developed by John Murphy, you know it's a brilliant concept, right?
Yes, exactly. I think you made a great point too earlier about, those crossovers. I just wanted to make a mention is the fact that crossovers are attention flags. I always tell people to never, ever trade off of signals. We're market timers at Decision Point. So we give out a lot of signals. You don't want to go in and just because something gave you a buy signal, just go all in. Because as you've seen on the program, a lot of times when I look at a chart, just because you got the crossover doesn't mean the chart looks the best for investing.
Completely agree. And looking at the market does not want to go all in 30 minutes before the Fed. The Dow Jones right now down 1 point. The NASDAQ down 10, the S&P down 2 points, and the Russell 2000 down 1 point. So I think that is a sign that the market is certainly looking for, just sitting on pins and needles waiting on the Fed.
Oh, yes.
The upcoming schedule. I want to thank all of you for being with us. Please remember to complete the survey as you exit. As a quick reminder, Market Watchers Live airs 5 days a week, Mondays through Fridays, from noon to 1:30 p.m. Eastern Standard Time. Have a great Wednesday afternoon, everybody. Somebody in the chat room called it Fed Wednesday. I thought that was kind of cute. Anyway, everybody have a great afternoon. We'll see you back here tomorrow. Happy trading.